Silver trades at $67 in New York, but Shanghai demands $72 for the same ounce. That's not a premium, it's a fracture. Physical bars vanish from Western vaults at record speed, while paper contracts multiply unchecked. Deliveries stretch from days to weeks, allocations shrink by 30%, and wholesalers quote, "call us," instead of prices. This disconnect isn't volatility. It's the system admitting it can't supply what it prices. Right now, as Asian markets stir, one industrial bid could shatter the illusion, forcing $73 or higher before dawn breaks in the West. Institutions hoard physical, ignoring futures, because the math no longer holds. Arbitrage profits evaporate into logistics black holes. Regulators watch in silence. Media echoes nothing, signaling the break is deeper than admitted. Here's where the logic snaps. A market built on infinite paper now chokes on finite metal. This isn't a rally, it's a realignment. Look at the flows. Western banks, positioned short on billions in contracts, assume control through endless selling of derivatives that never touch the ground. But Shanghai doesn't trade promises. It moves bars to factories grinding solar panels, circuit boards, and munitions. Inelastic demand doesn't blink at $5 spikes. It bids higher to secure continuity. Consider the solar sector alone. Global output requires 150 million ounces annually, up 20% from last year amid energy transitions. A single fab line halt costs $10 million daily in lost contracts. So when suppliers cap deliveries at half requested volumes, buyers don't negotiate. They overpay. This urgency cascades. One procurement panic in Shenzhen ripples to refiners in Perth, who reroute shipments eastward, starving London vaults. The premium holds at $4 to $5, not because of greed, but because shipping containers sit idle in ports, delayed by geopolitical choke points like the Red Sea diversions that added 15% to transit costs since 2024. No one risks the voyage when insurance premiums triple on whispers of escalation. History mirrors this fracture without mercy. In 1980, the Hunt brothers cornered silver, pushing prices to $50 amid industrial scramble, until exchanges hiked margins overnight, forcing liquidation. That worked because physical stocks overflowed. Over 200 million ounces sat idle. Now, registered inventories in COMEX hover at 280 million ounces, but eligible for delivery? Barely 50 million, down 40% year over year as holders pull metal off exchange. Palladium in 2020 echoed it. Russian supply disruptions widened spreads to $300 per ounce, and Western shorts scrambled as auto catalyst demand refused to yield. Nickel 2022 was the brutal lesson. LME halted trading after a 250% spike, citing disorderly markets, but really to bail out shorts facing $20 billion losses. Silver's vulnerability is smaller scale, tighter fundamentals. Annual mine output at 850 million ounces meets 1.2 billion in demand. The deficit filled by recycling that's now strained by e-waste export bans in Europe. Where 1980 had surplus, 2025 has scarcity baked in, amplified by military drawdowns, silver and hypersonic missiles, and stealth coatings, with U.S. stockpiles reportedly dipping 25% amid Pacific tensions. The silence from regulators compounds the signal. CFTC reports show open interest swelling 15% in futures, while physical withdrawals accelerate. No inquiries, no caps announced. Media blackout on dealer premiums hitting 20% for retail bars. Kitco and APMEX list out of stock on 100-ounce lots, forcing buyers to secondary markets at $75 equivalent. This isn't oversight, it's avoidance. If the system were stable, these gaps would close via arbitrage. Buy low in West, ship East, sell high. But freight rates from New York to Shanghai jumped 50% in 6 months, and customs holds multiply on security checks. The bridge isn't just broken, it's barricaded. Banks, leveraged 20 to 1 on shorts, can't unwind without self-inflicted spikes. They sell more paper to defend $67, but each contract widens the chasm, exposing the fraud, pricing power without possession. If you've tracked metal flows in your corner of the industry, perhaps in electronics or mining, how does this premium persistence align with what you're seeing on the ground? Share your observations in the comments. It might reveal patterns I'm missing from the aggregate data. Geopolitics weaves in here, inverting cause and effect. Western sanctions on Russian palladium in 2022 rerouted silver as a proxy hedge. But now, China's dominance in refining, 60% of global capacity, turns the tables. Beijing's stockpiling, up 30% per state reports, isn't hoarding. It's strategic insulation against dollar weaponization. When the U.S. Treasury blacklists entities, metal doesn't flow west. It pools east. Logistics amplify. Container shortages from 2024 trade wars mean a 10-day delay becomes 30, and costs eat arbitrage margins. Military parallels emerge subtly. Silver's role in EMP-resistant tech mirrors oils in 1973, where OPEC's embargo fractured Western control. But here, no cartel decrees it. Demand does. Factories in Vietnam and India, shifting from China, compete for the same ounces. Bidding wars ensue. The consequence precedes the cause. Premiums spike first, revealing the underlying blockade later. Thin liquidity turns routine trades into ruptures. Shanghai's order books, shallower post-holidays, mean a 100,000-ounce order, standard for a mid-tier fabricator, prints $1 to $2 higher instantly. No flood of sellers appears because holders sense the shift. Why sell at $72 when whispers of $75 circulate? This self-reinforces, like 2008 credit markets, where bid-ask spreads ballooned from cents to dollars overnight. Banks' models, tuned for speculative flows, fail here. Physical buyers don't fade rallies, they fuel them. Shorts, nursing $5 billion in unrealized losses at current levels, face margin calls if 73 hits. Covering requires buying back contracts, accelerating the updraft. Where does the system lose stability? Right at this pivot, from price-sensitive speculation to scarcity-driven acquisition. The West's response exposes the asymmetry. Attempts to manage via paper dumps backfire. Each short sale detaches futures further from spot. If Shanghai holds $73 while COMEX lingers at $68, the arbitrage vacuum sucks in opportunistic funds. But without metal to ship, it's a phantom play. Institutions pivot. JP Morgan's reported 15% increase in physical holdings last quarter signals the flight to tangibles. Retail follows. Coinbase Silver ETF inflows up 25% weekly, but dealers ration, premiums soar. This isn't growth, it's evacuation. Silence from the Fed on lease rates climbing to 2% annual, triple the norm. Screams containment failure. In a sustainable system, rates draw supply. Here, they repel it, as lenders hoard against default risks. For those following global trade data closely, does this eastward rerouting of silver shipments match the customs reports you've seen? I'd be interested in your take. Drop it in the comments to cross-reference against the official figures. Interventions loom as the ultimate fracture point. When paper credibility cracks, rules morph. Margin hikes from 10% to 50% overnight, as in nickel, force liquidations. Trading halts. For volatility, position limits capping shorts at 5,000 contracts. Emergency CFTC probes blame speculators, echoing Hunt 1980. But efficacy wanes. Physical trades migrate off exchange to Dubai or Singapore hubs, where premiums already test $74. Peer-to-peer networks, blockchain-tracked, bypass COMEX entirely. The 2022 nickel fiasco taught that halting doesn't resolve shortages, it displaces them. Silver's dual role, industrial staple and monetary hedge, makes suppression pyrrhic, crush the price, and solar output falters. EV batteries stall, defense contractors scramble. Geopolitical ripple. If West loses pricing authority, dollar-denominated commodities question hegemony. Gold tests $3,000 as the next domino. Symptoms manifest before causes clarify. Monday's failed smash. Banks dumping 50,000 contracts to cap at $66. Rebounded to $67 close. Premium intact. That's not resilience, it's rejection. Physical fear spreads via back channels. Procurement emails citing allocation limits. Refiners holding output for preferred clients. A solar exec's urgent buy at $74 isn't news. It's the mechanism. Thin markets don't climb, they leap. One rumor, say, a major mine flood in Peru, cutting 5% global supply, catalyzes. But even without, inertia breaks. Unresolved spreads erode confidence. Shorts capitulate en masse. If you're in procurement or supply chain management, how are these delivery delays manifesting in your operations right now? Your experiences could illuminate the real-time stress points. Share them in the comments. Power transfers eastward, not through decree, but default. Shanghai's $72 isn't a bid. It's the floor where physical clears. West follows or fractures, either crushes shorts or exposes emptiness. Historical parallels sharpen. 1971. Nixon shock ended gold convertibility, birthing fiat volatility. Now, silver's inconvertibility unmasked paper overreach. Military undercurrents. Silver and F-35 avionics. Tomahawk guidance. U.S. DoD contracts demand 10 million ounces yearly, but with inventories thinning, premiums infiltrate budgets. Logistics knots tighten. Panama Canal droughts add weeks. Suez risks reroute via Cape, inflating costs 20%. No conspiracy, just converging pressures where system resilience presumed infinite supply. The premium's persistence isn't anomaly, it's indictment. At $4 to $5, it should lure arbitrageurs like flies, yet they abstain. Delivery risks outweigh profits. Banks, trapped in shorts, opt for paralysis. Cover and spike prices, or double down and risk cascade. Option 3. Intervention. Buys time but erodes trust. Scenarios unfold. Base holds 72 to 73 intraday, signaling floor lift. Bull pushes 73.50 to 74 on aggressive bids, widening spread to 7. Cooling lingers 71 to 72, but unresolved tension builds for Wednesday rupture. Key, premium closure. If not, crisis accrues. Those analyzing historical market breaks, how does this silver disconnect compare to the palladium squeeze of 2020 in your view? Weigh in below with your parallels or divergences. It adds depth to the collective read. Causes surface late, but consequences scream now. Inelasticity rules. A $50 million contract trumps $2 per ounce overpay. Physical fear outpaces headlines. CNBC arrives post-spike. Banks' nightmare. Selling paper into vacuum just highlights detachment. Confidence erodes not in crashes, but divergences. New York $67, Shanghai $73, and buyers flock to the deliverable. Regulators quiet, tacit admission control slips, media void, narrative quarantine failing. If you've noticed similar premiums in other metals like copper or gold lately, what patterns are emerging from your perspective? Your insights in the comments could connect the dots across commodities. The process grinds onward, stability yielding to entropy. Tuesday tests the line. Premium firm, West stalls, bids hit, levels print. No lurch to $100 yet, but the pivot from paper dominion to physical dictate. Interventions may stall, but fundamentals persist. 350 million ounce deficit projected 2026. Mining capex down 15% amid permitting wars. Geopolitics seals it. East refinement lock meets West sanction fatigue. History reflects, post-2008, gold decoupled from dollars. Silver now decouples from futures. The fracture widens, control dissipates, one unclosed spread at a time. For investors or traders who've weathered past squeezes, does this feel like the prelude to a full repricing or something containable? Lay out your reasoning in the comments. It's valuable to gauge the spectrum of interpretations. This isn't climax, it's phase shift. Banks is kill switch, paper floods, rule tweaks, misfires against physical tide. Shanghai asserts, West recedes, narrative unravels. The system, once seamless, now exposes seams. Empty vaults, jammed flows, silenced overseers. Pressure builds unchecked, reset inevitable. Watch the premiums, they dictate the timeline. The metal endures, the mechanisms do not. Shanghai opens at $72.40, while New York closed the prior session at $69.46. That's not alignment, it's divergence. A $2.94 premium persists into the Asian session, widening from yesterday's close, despite record volumes on both exchanges. Physical deliveries in China accelerate, with Shanghai Gold Exchange inventories drawn down 8% week over week as refiners secure metal for year-end contracts. Western vaults report steady outflows. COMEX-eligible stocks dip below 45 million ounces, the lowest since the 2022 nickel disruption. Dealers quote retail bars at $75 to $78 equivalent. Allocations capped at 20% of orders. This isn't correction, it's confirmation. The bridge held firm yesterday, but the strain shows. Arbitrageurs abstain, logistics choke, and urgent bids fill the vacuum. Tuesday tested the fracture, and the system bent without snapping. Shanghai printed $72.69 at settle, absorbing Western paper dumps that failed to drag it lower. COMEX attempted defense around $68, selling 40,000 contracts in thin holiday liquidity. Yet buyers lifted offers relentlessly. No cascade followed, no forced covering spiral. Instead, a controlled ascent. Intraday highs touched $70.15 before easing on profit-taking. Premiums refused to collapse, holding above $3 as Eastern demand asserted priority. Industrial offtake dominated. Solar fabricators in Guangdong bidding size, electronics suppliers covering Q1 exposure. One mid-tier refiner's 300,000-ounce lift shifted the tape visibly, printing levels that forced shorts to reconsider timelines. The West hesitated, banks stalled, and physical flow dictated the close. History judges these moments harshly. Nickel 2022 spiked 250% in days when Russian supply vanished. LME halted trading to protect shorts. yet physical rerouted to China untouched. Palladium 2020 widened spreads to $400 as auto catalysts prioritized allocation over price. Silver echoes both. Deficits compound, 350 million ounces cumulative since 2021. Recycling strained by export curbs. Mining output flat at 850 million amid permitting delays in Peru and Mexico. Where 1980 overflows allowed margin hikes to crush speculation, 2025 scarcity insulates rallies. Interventions buy hours, not resolution. Raise margins, and off-exchange trades flourish in Dubai or private vaults. Halt COMEX, and Shanghai simply leads unchallenged. Geopolitics embeds deeper. U.S. critical mineral listings pull silver westward preemptively, mirroring copper stockpiling, while China's 60% refining lock reroutes flows eastward permanently. Red Sea disruptions linger, adding 18 days to transit, insurance up 40%. No overt blockade, yet convergence. Sanctions fatigue meets strategic hoarding. Military drawdowns accelerate. Silver and guidance systems, stealth materials, DoD requirements up 15% amid tensions. Inventories thinning without fanfare. Factories don't pause for dips. They secure continuity at any premium. A single EV battery plant delay costs $20 million weekly. $3 extra per ounce is irrelevant. Liquidity thins post-holidays, amplifying impact. Shanghai's shallower books mean routine 200,000-ounce orders reset highs effortlessly. Sellers withhold, sensing the floor rise. Buyers chase, fearing allocation cuts. Lease rates climb to 2.5%, triple norms, yet lenders hoard rather than lend. Western shorts, down $6 billion unrealized, face the vice. Cover and accelerate, hold and bleed, or sell more paper into inelastic walls. Each choice widens detachment. Confidence erodes not in crashes, but sustained divergences. New York $69, Shanghai $72, and deliverable metal flows east. If you've monitored refinery backlogs or dealer allocations in your region, how persistent are these premiums showing up locally? Your ground-level view could sharpen the picture. Note it in the comments. Symptoms outpace explanations again. Monday's momentum carried, failed smashes absorbed, spreads unresolved. Procurement channels buzz quietly. Limited quotes, delayed shipments, preferred clients only. Solar procurement, one major player's $74 acceptance for 400,000 ounces, ripples without headlines. Then markets leap, not climb. Rumors of Peruvian output cuts circulate, but even absent catalysts, inertia fractures. Banks' models, calibrated for speculation, misread scarcity. Physical doesn't fade, it fronts. The eastward tilt accelerates subtly. China's stockpiles rise 25% year-to-date per indirect metrics, insulating against dollar risks. Western sanctions reroute proxies, but now refinement dominance flips leverage. Logistics compound, canal delays, port holds on compliance. No decree needed, demand enforces. Vietnam's fab shifts compete directly. Bidding wars ensue quietly. Consequences manifest first. Premiums embed, then causes clarify. Blockades implicit, flows redirected. For those tracking historical dislocations, does this $3 plus SHFE COMEX spread evoke the Palladium 2020 asymmetry or something more structural? Share your comparisons below. It refines the read. Interventions hover as fallback. When paper legitimacy wanes, mechanics shift. Position limits, volatility halts, speculator probes. Nickel taught displacement. Trading migrates, shortages persist. Silver's hybrid nature complicates, suppress, and solar stalls. Defense contracts scramble. EV margins erode. Geopolitical cost. Pricing authority lost questions. Commodity hegemony broadly. Gold watches closely. $4,500 breached as correlative safe haven flows intensify. Thin dynamics self-reinforce. One serious bid prints $73 equivalent intraday flashes. Psychology shifts. Sellers freeze, chasers emerge. West reacts belatedly. Paper sales highlighting disconnect. No full spike yesterday, but base case held. 72 to 73 territory probed, floor elevated. Bull scenarios deferred, yet premium persistence accrues pressure. Cooling absent, tension builds for post-holiday catalysts. If you're in industrial procurement, how are these allocation caps and quote delays impacting planning right now? Details from the front lines and comments would illuminate the urgency. Power doesn't announce transfer, it defaults. Shanghai's lead isn't assertion, it's consequence. West follows partially or exposes limits. Shorts contained yesterday, but at cost. Historical resets. 1971, gold window closed, birthed volatility. Now, Silver's paper physical gap unmasks overreach. Military threats tighten. Avionics demands compete civilian. Budgets absorb premium silently. The premium's stubborn hold indicts more than any headline. At $3, arbitrage should swarm. Yet risks deter. Banks paralyzed. Unwind spikes, double down cascades, intervene erodes. Scenarios narrowed yesterday. Slow burn prevailed. Continuation setup intact. Among those who've observed past squeezes firsthand, does yesterday's absorption of paper defense feel like containment or prelude to acceleration? Your interpretations and comments add crucial perspective. Causes lag, effects compound. Inelastic bids rule. Multi-million contracts outweigh ounce premiums. Fear transmits privately. Emails, calls, rations. Banks' exposure. Paper into vacuum exposes illusion. Regulators mute. Media sparse. Containment strains. If similar divergences appear in copper or platinum from your vantage, what interconnections stand out? Connect them below for broader context. Process advances inexorably. Equilibrium receding. Tuesday absorbed the test. Premium intact. Control diluted. Interventions may delay, but deficits endure. 400 million ounce gap forecast, 2026. CapEx curtailed. East's grip firms. West's recedes. One persistent spread at a time. Metal prevails. Constructs yield. Premium signal the phase. Repricing underway. Dominance shifting. The fracture holds, widening gradually. Shanghai settles at $72.69 on December 23, 2025, while COMEX futures linger at $69.80 into the evening fix. The $2.89 gap doesn't narrow, it embeds. Physical withdrawals from Shanghai vaults exceed 2 million ounces in a single session, the highest daily draw since the 2021 solar boom began. Western dealers report fresh rationing. 1,000-ounce bars allocated at 10% of requested volume. Premiums pushed to $4.50 over spot for immediate delivery. Retail platforms list delays stretching to February, with sold-out banners on standard products that moved freely 6 months ago. This isn't seasonal tightness, it's structural depletion. Eligible COMEX stocks slip another 1.2 million ounces overnight as holders transferred to private vaults off exchange. The metal isn't vanishing, it's relocating, eastward, irreversibly. Wednesday dawns with the fracture deeper. Asian liquidity remains thin. Post-holiday hangovers thinning order books further. A single 500,000-ounce industrial lift in early Shanghai trade prints $73.15 before retracing modestly. No seller flood follows. Holders watch, calculate, withhold. Lease rates spike to 3.1%, the highest since the 2008 crisis. Yet metal stays locked. Lenders refuse to part with bars at any rate, signaling not greed, but fear of non-return. Western banks dump another 35,000 contracts in the Globex session, attempting to cap at $70. Absorption is immediate. Buyers step in without hesitation. The defense costs more each day. Unrealized short losses now approach $7 billion across major players. Margin deaths whisper of internal reviews, but no unwinds materialize. Paralysis sets in. Geopolitical currents run beneath the numbers. China's year-end refinery maintenance schedules quietly extend, holding output offline longer than announced. Peru's Antamina mine reports fresh permitting delays, trimming 2026 guidance by 8 million ounces before operations even ramp. Mexico's community blockades intensify, cutting another 5% from projected supply. No headlines dominate, yet cumulative impact compounds the deficit. Already 380 million ounces projected for 2025 to 2026 combined. Recycling flows slow as European e-waste directives reroute scrap eastward, where recovery rates favor state-affiliated processors. The West loses feedstock at both ends, primary and secondary. Military procurement layers additional pressure, unacknowledged in public reports. Silver's conductivity in radar arrays and missile guidance demands absolute reliability. Substitutes fail at scale. U.S. defense contractors bid discreetly through intermediaries, accepting premiums that would shock civilian buyers. A single F-35 production batch consumes 50,000 ounces. Delays cascade into billion-dollar penalties. When allocation letters arrive stating partial fulfillment, contracts override cost concerns. This demand is silent, inelastic, and growing amid Pacific posture shifts. If you're seeing these refinery extensions or mine delays reflected in your supply contracts, how much lead time are you actually getting now? Ground reports in the comments would map the real constriction. Logistics remain the unspoken choke. Baltic freight indices for dry bulk hold elevated, but container availability from Australian refiners to Asian ports drops 22% week over week. Insurance underwriters flag Red Sea routes as high risk. Rerouting via Cape adds 22 days and 25% cost. Arbitrage mathematics invert. The $3 premium no longer covers transit expense plus risk. Ships sail half full or not at all. Metal pools where demand is sovereign. The premium's refusal to close is the clearest verdict. At $2.89 sustained, the system should self-correct. Yet it doesn't. Banks face the trilemma: cover and spike higher, defend and bleed capital, or intervene and expose fragility. Each path erodes control further. Shanghai's lead solidifies not through aggression, but persistence. Physical clears there first, at whatever price continuity demands. For those tracking defense-related metal flows, are you noticing similar priority rerouting in your channels? Observations below could reveal the hidden draw. The process accelerates quietly. Wednesday $73.15 print, even intraday, resets expectations. Sellers now anchor higher, buyers accept the new floor. Pressure accrues without drama. Interventions lurk, but efficacy diminishes. Margin hikes displace rather than resolve. Halts accelerate off-exchange migration. Fundamentals override mechanics. Deficits deepen, flows redirect. Dominance shifts eastward, one unclosed spread at a time. The fracture widens, control dissipates, and the metal dictates terms the paper once presumed to set.